This paper, as you can see, is co-authored with three very hard-working financial economists, two of whom are also at UNSW. One's a PhD student who will be on the market next year. That's Claire, as well as my colleague Le Zhang. And then we also have one of Le's former colleagues, Angie Lowe, also on the paper. Motivation for our study starts by looking at the U.S. And recognizing that large shareholder influence over corporate governance primarily is channeled through the board. And the board's got great powers, as we know. It's a gatekeeper of all shareholder proposals. It approves almost all major corporate decisions and has the power to hire and fire CEOs and set compensation. And since the passage of Sarbanes-Oxley, the boards are primarily composed of outside directors. Recent evidence shows, in particular, independent directors. Now, recent evidence shows that the effectiveness of these independent directors varies greatly. And their monitoring incentives, based on a number of studies, do not appear to be that strong. Their financial incentives appear to be relatively weak. There's papers by people like Adams and Ferreira that document that. The effectiveness of the labor market's penalties on directors is unclear and controversial at this point. And director reputation incentives vary with the number of other directorships they may also hold. And so the key question we want to address is, does board performance significantly benefit from having active shareholder monitoring? And shareholder monitoring, or effectiveness in monitoring, unfortunately, has limitations. Shareholder incentives are limited due to the fact that shareholders, certainly in countries like the U.S., have very limited ownership blocks. The amount of expertise and credibility that they have individually is limited, and they have difficulty in coordinating with other individual shareholders. Now, one possible exception to that would be institutional investors, and they have stronger incentives to monitor, in part because they have larger shareholdings, and that means that they're exposed to much more severe agency problems than otherwise. They also have access to very sophisticated financial expertise, and then finally, there are several studies, recent studies, empirical studies show that these investors appear to improve corporate decision-making and firm value, but they're largely silent on the channels through which this might occur. So the basic research question we're going to look at is, do institutional investors improve board monitoring incentives and board effectiveness? And the existing evidence, as you would have gathered from the first talk that Randall just gave, emphasizes shareholder activism activities, including proxy contests and lawsuits and joining the board. But these actions tend to be relatively rare. And they occur in only a small group of firms, and they're conducted generally by a very limited set of specialized institutional investors, typically hedge funds. Yet, board incentives generally need to be improved beyond strong shareholder activism and the threat of such activism. And surprisingly, the literature generally overlooks how non-activist shareholders can also potentially influence board monitoring. So we're going to look at, consider two competing hypotheses. The first one is that institutional monitoring is good. Without shareholder monitoring, it's unclear whether independent directors have sufficient incentives to do a good job, as I've already noted, weak financial incentives. And even if they had strong financial incentives, it's not optimal, not necessarily optimal for that to occur, because that might encourage them to have collusive arrangements with management. Also, directors have very limited labor market reputation incentives. Directors appear to be punished only when extreme events occur, and the punishment appears to be insufficient to create very strong performance incentives, at least based on some recent studies. The alternative hypothesis is that institutional investors are not effective monitors. Monitoring is costly, subject to free rider problems. Voice is costly because it reduces potential private benefits and access to information for management. Exit can be costly because of liquidity concerns. And more importantly, institutional investors bear all the cost of their intervention, but they're only going to realize a fraction of the benefits. In addition to that, we've got a number of studies recently that document that certain types of institutions don't even have the appropriate incentives to pursue costly intervention, which are often called gray institutions, due to the fact that they sell products to the company and want to continue to do so, and so they have incentives to be shareholder friendly. And then finally, these institutions are agents of their own shareholders with conflicts of interest of their own. Now, what we're going to focus on here is identifying the causal effects associated with institutional investor activity. And we're going to do that by focusing on distractions of these investors. So basically, the challenge is that if you just looked at changes in share ownership by institutions, then you've got the potential that institutions are changing their ownership because they expect firm profits to go up or go down. And that's going to cause a potential reverse causality problem if you're going to try and argue that those shareholder changes actually cause changes in firm activity. So we're going to follow a recent strategy by Kempt et al., and we're going to look at unrelated return shocks to the portfolios of individual institutions, and use that, and these are going to be our exogenous variation in institutional monitoring. So we're going to define a shock as when another French 12 industry sector, other than the one where our focal firm is in, is experiencing either very high or very low returns relative to the other industries in a given quarter. And investors, we're going to presume, have a limited supply of attention, so that they tend to allocate more of their time and energy to industries with extremely good or extremely bad returns. And there's several empirical studies that support this conclusion, and it can be based on either a rational explanation in terms of how much processing of particularly valuable information occurs in booms and recessions, or it can be based on behavioral explanation that people tend to pay more attention to extreme events. Now, how do we actually obtain our distractions by a particular institution? Well, we adjust for the importance of the exogenous industry shock using the institution's industry portfolio weight. So what portion of that industry's portfolio is in this shocked industry sector? And then what we do is we aggregate the various industry distractions borne by all the institutions that are holders in this focal firm. And we weight by each of the institutions' shareholding percentages in the focal firm. And to the extent that the shocks are in other industries, we're going to argue that they're independent of the fundamentals in this firm. So what do we find? Well, when we construct these measures of distraction, we find that there's evidence that there is a weakening in board governance. And what we document is that that distracted institutions lead to weaker board oversight. For instance, they are less likely to vote against ineffective independent directors. Now, what do we mean by ineffective? Well, directors who have poor attendance, who appear co-opted, who are overly busy, or socially connected to the CEO. I might note also that this voting is quite important. Even though very few directors get voted out of companies, there's some very interesting and important recent studies that show, particularly one by Agarwal, Daya, and Pravala, that show that independent directors with relatively weak election results are much more likely to leave the board, presumably of their own accord. And that is interpreted as a reaction to their reputation being adversely affected by weak voting results. Now, with weaker institutional investor oversight, we find that board monitoring intensity falls. We find that independent directors miss more meetings. We find that boards hold fewer meetings in the year. And this is true even if we use firm fixed effects in our analysis. And this is controlling for a number of other standard variables that would partially explain these activities. And then we also find that distracted independent institutional investors also lead to poor board monitoring results. We find that there are more conflicted directors who are appointed to these boards in the periods of these distractions. And we find that the boards tend to approve higher CEO excess pay. And this is pay that's above the predicted level of pay. And boards accept more earnings management, which is where the accounting accruals, which are the non-cash flow elements of earnings that are discretionary to the firm, appear to be used to pump up reported earnings. So in conclusion, we examine how monitoring by institutional investors influences board governance by constructing this measure of investor distraction, which captures an exogenous set of shocks on shareholder attention. And we find that these distractions weaken board oversight, which in turn leads to weaker board monitoring incentives, and finally to poor board monitoring quality. And our findings suggest that these institutional investor monitoring represents a very important determinant of the board monitoring incentives and board performance. And so this study extends our understanding of how institutional investors can intervene in their portfolio firms to improve corporate governance and firm value without resorting to what's often viewed as investor activism or overt investor activism. Thank you.